Welcome to the Retirement Wealth Podcast. I'm so glad you're joining us today.
Absolutely. It's great to have you here with us.
So, one topic that often trips people up in retirement planning is capital gains tax.
Right? It can be a real head scratcher if you're not familiar with it.
Exactly. Understanding how capital gains tax works can really impact your retirement income and financial strategy.
And it's especially important as you begin to sell investments or properties.
Today, we'll dive into the ins and outs of capital gains tax and how it affects your overall retirement plan.
We'll also discuss some strategies to minimize your tax burden, which is crucial for maximizing your retirement savings.
Oh, and we can't forget about the differences between short-term and long-term capital gains.
Yes, understanding those differences can help you make smarter decisions when it comes to your investments.
So we've got a lot to cover, and I think our listeners will find it really valuable, especially if they're looking to fine-tune their retirement strategy.
Absolutely. Let's get into it.
All right, let's start with the basics. What exactly is capital gains tax, David?
Emily, understanding capital gains tax in retirement is super important right now, especially considering how things are shifting economically.
Absolutely, David. A lot of people might not realize how capital gains can affect their retirement income, especially with inflation being such a big topic these days.
Right. When we think about retirement timelines, so many of us are looking at our investments and wondering how they'll hold up. With inflation nibbling away at purchasing power, having a solid strategy around capital gains becomes even more essential.
Exactly. And let's not forget market volatility. With all the ups and downs in the market, those capital gains can swing quite a bit. I recently spoke with a couple, the Johnsons, who had planned to retire this year. But now they're reconsidering because they're worried about how much they'll actually keep after taxes.
That's a common concern, for sure. I had a similar conversation with a client last week. They're looking at selling a rental property they've held for years. They're excited about the profit. But when I mentioned the potential capital gains tax, you could see the worry on their faces.
Yeah, it can really change the perspective, can it? Especially when folks are trying to balance their Social Security benefits with other income streams. If they're not careful, those capital gains can push them into a higher tax bracket.
Exactly. And that can affect not just their current tax situation, but also their long-term financial picture. I often remind clients that tax efficiency is key in retirement. It's all about keeping more of what they've worked so hard to earn.
Right, and with healthcare costs rising, that's another layer to this whole conversation. If retirees aren't aware of how capital gains can impact their overall financial health, they might find themselves in a tough spot when those medical bills come in.
True. I had another client, Karen, who was planning for her healthcare expenses but hadn't factored in how selling her stocks could trigger capital gains taxes. When we ran the numbers, it became clear that she'd need to reassess her withdrawal strategy to avoid unnecessary tax hits.
That's a great point. It's almost like a domino effect, right? One decision can lead to a whole cascade of other financial implications. And we haven't even touched on legacy planning yet.
Yes. Legacy planning is huge. Many people want to leave something behind for their kids or grandkids, but if they don't understand capital gains, they might inadvertently reduce their heirs' inheritance through taxes.
Exactly. I've seen families that thought they were doing everything right, only to find out that selling the family home or investment properties could lead to significant capital gains tax burdens on the heirs.
It's a delicate balance. And with current economic trends, like rising interest rates and fluctuating real estate markets, it's even more critical for retirees to understand how to manage their investments efficiently.
For sure. And emotionally, it can be tough too. Many folks are already feeling stressed about financial security in retirement. If they realize they might owe a hefty tax bill later on, it can add even more anxiety.
Yes, and that emotional side shouldn't be underestimated. Retirement should be a time of enjoyment and peace, not worry over taxes and finances. When people feel secure in their planning, it can really enhance their quality of life.
Absolutely. And so many people want to do right by their families. But if they're not well informed, they can end up making decisions that don't align with their original intentions.
Right, and that's why it's crucial to have these conversations now, not just as a last-minute thought before retirement. The earlier people start planning, considering capital gains, tax strategies, and overall financial health, the more prepared they'll be.
So true. It's all about being proactive, isn't it? I think a lot of people put off talking about these things because they feel overwhelmed or unsure, but that's where financial advisors can really step in and help.
Exactly, Emily. A good advisor can help create a tailored strategy that considers all these factors: capital gains, income streams, tax brackets, and even future healthcare costs. It's about seeing the bigger picture.
And making sure people feel confident in their decisions, right? Nobody wants to feel stuck or regretful about their financial choices.
Right. So as we transition into discussing some specific strategies, let's keep in mind that the goal is to empower listeners with knowledge. That way, they can navigate their retirement years with more clarity and confidence.
Perfectly said, David. Let's dive into those strategies so our listeners can start putting this knowledge into action.
So, Emily, as we dive into capital gains tax, it's really important for our listeners to understand how it impacts their retirement planning.
Right, and I think a good starting point is to clarify what capital gains actually are. So when you sell an asset for more than you bought it for, that profit is your capital gain, right?
Exactly. And there are two types of capital gains: short-term and long-term. Short-term gains apply to assets held for a year or less, and they're taxed at ordinary income rates. Long-term gains, on the other hand, apply to assets held for more than a year and are taxed at a lower rate, which can be a real advantage in retirement.
That makes sense. So if someone is retired and has investments they've held for a while, they're more likely to benefit from those lower long-term capital gains tax rates?
Absolutely. And that's why it's crucial to think about the holding period of your investments. For instance, let's say you bought shares of a stock for $10,000 and sold them later for $15,000. If you held them for more than a year, you'd only pay long-term capital gains tax on that $5,000 gain, which is typically lower than your income tax rate.
And that's a big deal, especially if you're relying on those investments for income in retirement. Now, how does this all tie into things like 401ks and IRAs?
Great question. With tax advantage accounts like 401ks and traditional IRAs, you don't pay capital gains tax on the investments within those accounts while they're growing. It's only when you start taking distributions that you'll pay taxes, and those would be taxed as ordinary income, not capital gains.
That's why a lot of retirees choose to do some strategic withdrawals, right? Like taking out just enough to stay in a lower tax bracket?
Exactly. You might want to consider the quote cake 4% rule, which suggests that withdrawing 4% of your portfolio annually can help ensure your money lasts throughout retirement. But it's important to adjust that based on your unique tax situation, especially if you have significant capital gains.
So if you're planning your withdrawals carefully, you can minimize the tax impact on your retirement savings.
Yes, and a bucket strategy can also be effective. You could have buckets for different time horizons, short-term needs in cash or bonds, and long-term growth in stocks. This way, you're not forced to sell investments at an inopportune time, which could trigger capital gains taxes.
That's a smart approach. And diversification plays a big role here too, right? Not just in terms of asset classes, but also in tax treatment.
Absolutely. By diversifying your investments among taxable accounts, tax-deferred accounts, and tax-free accounts like Roth IRAs, you give yourself more flexibility in retirement. For example, with a Roth IRA, your withdrawals are tax-free if you follow the rules, which can help you manage your overall tax liability.
And speaking of Roth IRAs, what's the deal with conversions? When should someone consider converting a traditional IRA to a Roth?
Converting to a Roth can make sense if you expect to be in a higher tax bracket in the future, or if you want to leave tax-free money to your heirs. Just keep in mind that you'll pay taxes on the converted amount in the year you do the conversion, so it's wise to plan that for a year when your income might be lower.
That's such a good point. Timing really matters when it comes to taxes. Now, what about real estate? How does capital gains tax work there?
Well, if you sell a primary residence, you can exclude up to $250,000 of capital gains, $500,000 for married couples, if you meet certain criteria, like having lived in the home for 2 of the last 5 years. That's a huge benefit for homeowners in retirement.
So if someone bought a home decades ago and it's appreciated significantly, they could potentially sell it and keep a good chunk of that profit tax-free?
Exactly. But if it's an investment property, the rules are different. You might have to pay capital gains tax on the entire profit unless you do a 1031 exchange to defer those taxes by reinvesting in another property.
And that's where strategic planning comes into play again, right? Knowing when and how to sell various assets can really impact your tax situation.
Definitely. And let's not forget about Social Security. Depending on your total income, including capital gains, up to 85% of your Social Security benefits could be taxable. So it's crucial to consider all sources of income when planning your withdrawals.
Wow, that's a big surprise for many retirees. They might not realize that their investment gains can affect their Social Security taxability.
Right! And this is why understanding your overall asset allocation is so vital. A balanced portfolio that takes taxes into account can help you optimize your retirement income and minimize tax liabilities.
So what are some common strategies you'd recommend for managing capital gains tax effectively as people approach retirement?
One key strategy is to periodically rebalance your portfolio. This can help you maintain your desired asset allocation and prevent excessive gains from being realized all at once. Also, tax loss harvesting, selling losing investments to offset some gains, can be quite effective.
That's a great tip. And I imagine it's also important to keep an eye on your overall asset allocation. You mentioned the 70/30 portfolio, 70% stocks and 30% bonds. Keeping that balance can help with both growth and risk management.
Exactly. And remember, as you get closer to retirement, you might want to gradually shift more toward bonds or conservative investments to protect your capital. This can lower your exposure to potential capital gains.
This all ties back to having a solid plan, doesn't it? It's about making informed decisions based on your personal financial situation and long-term goals.
Absolutely, Emily. And the key is to stay proactive. Regularly review your investments and tax situation and adjust your strategy as needed. This can help you avoid some common pitfalls that retirees face with capital gains and taxes.
Speaking of pitfalls, let's shift our focus a bit. What are some of those common mistakes people make when it comes to capital gains tax in retirement?
So, one of the biggest pitfalls I see is people not really understanding the sequence of returns risk. It's something that can really catch retirees off guard, you know?
Absolutely. It's like if you have a few bad years early in retirement while you're withdrawing from your investments, it can really eat into your nest egg.
Exactly. I had a client, let's call him John. He retired in 2007, just before the financial crisis hit. He had planned to withdraw a certain percentage for his living expenses, but with the market tanking, his portfolio took a huge hit.
Oof, that's tough. So he was withdrawing while the market was down, right?
Right. And that kind of withdrawal strategy can decimate your savings. Because when the market rebounds, he was already pulling money out, which made it that much harder to recover.
That's such a clear example of why planning needs to be dynamic. What could he have done differently?
One thing he could have done was to have a cash reserve, enough savings to cover a few years of expenses so he wouldn't have to sell assets at a loss.
That makes total sense, and I think people often overlook the tax implications when they're withdrawing from their retirement accounts too, right?
For sure. Ignoring taxes can lead to a big surprise later. I worked with a couple, let's call them the Smiths. They were withdrawing funds from their traditional IRA without considering the tax impact, thinking they'd just pay whatever tax came due at the end of the year.
So what happened?
Well, they ended up bumping themselves into a higher tax bracket. Their withdrawals were substantial, and they didn't realize how much it would affect their overall tax liability. They ended up paying a lot more in taxes than they anticipated.
Yikes, that's a big lesson. What's a better approach?
A better approach would be to have a tax-efficient withdrawal strategy. For instance, they could have combined withdrawals from different accounts, like taxable, tax-deferred, and tax-free accounts, to minimize their tax burden.
And that requires a bit of planning, doesn't it?
Definitely. Another common mistake is underestimating healthcare costs. A lot of retirees don't factor in how expensive healthcare can be in retirement.
Right. Isn't that a big shock for many people?
Absolutely. I had a client, let's call her Linda, who thought her Medicare plan would cover all her needs, but she didn't account for things like long-term care or out-of-pocket expenses for medications.
That's a big oversight. What ended up happening?
Well, she had to dip into her savings much more than she planned. It's critical to have a healthcare budget and to consider long-term care insurance or other options.
So true. And then there's the issue of longevity. Many people underestimate how long they might actually live.
Yes, planning for a longer life is crucial. I had a client couple, the Johnsons, who figured they'd need about 20 years of retirement income. But with advances in healthcare, they're living into their 90s. They hadn't really prepared for that extended time frame.
Wow, that's a lot of extra years to plan for. How did that impact them?
They started to feel the pinch midway through their retirement. They had to adjust their lifestyle significantly because their savings were dwindling faster than expected.
That sounds stressful. So what can people do to avoid that?
They should consider using conservative estimates for withdrawal rates and plan for longer retirements. It's often recommended to plan for at least 30 years of retirement income.
Speaking of savings, what about asset allocation? I know that's another area where people can stumble.
Exactly. I had a situation with a retiree, let's call him Bob, who was still heavily invested in stocks. He thought he could handle the risk. But when the market took a downturn, he panicked and sold at the worst possible time.
That's a classic mistake. So what should he have done instead?
Bob would have benefited from a more balanced portfolio, one that includes safer investments as he approached retirement. It's all about having the right mix based on your risk tolerance and time horizon.
And many folks also claim Social Security too early, right?
Yes, that's a big one too. I had a client, Sarah, who claimed her benefits at 62 because she needed the money. But by doing that, she reduced her benefits significantly.
That's a tough decision. What should retirees consider before making that choice?
They should evaluate their financial needs and consider delaying benefits, if possible. The longer you wait, the more your benefits will grow, which can have a huge impact on your long-term financial health.
So it's really about understanding all these moving parts and how they interconnect, isn't it?
Exactly. And being proactive can help you spot red flags early on. If you notice you're feeling stressed about finances, or if your withdrawal strategy doesn't seem sustainable, that's a sign to reevaluate.
Great advice. So what are some next steps for someone listening who might be feeling a bit overwhelmed?
Well, it's important to have a thorough retirement plan that considers all these factors: taxes, healthcare, longevity, and more. Consulting with a financial planner can really help you create a holistic strategy.
It's never too late to make adjustments, right?
Right. Even if you're already retired, you can still make changes that can positively impact your financial future.
That's a hopeful note to end on.
I think so. Just remember, planning is an ongoing process, and staying informed can make all the difference. All right, so let's dive into some immediate steps that listeners can take right now to better understand and manage their capital gains tax situation in retirement.
Sounds great. I think a lot of folks feel overwhelmed, so having actionable steps is super helpful.
Absolutely. First off, I'd recommend checking out some retirement calculators. Websites like Vanguard, Fidelity, and Schwab offer user-friendly tools that can help you project your retirement income and, importantly, understand your potential tax obligations.
Yeah, those calculators can really simplify things. It's like having a mini financial advisor at your fingertips.
Exactly. You can input your investments and see how changes in your portfolio could affect your capital gains liabilities. It's a great way to visualize things without making any commitments.
And for someone who might not be super tech savvy, are there any specific tools or apps you'd suggest?
For sure. There are some fantastic financial planning apps out there, like Personal Capital or Mint. They can help you track your investments, spending, and even give you insights into your tax situation.
That sounds really useful. What about those who might need to dig a little deeper into their tax situation?
Good point. For those folks, I'd suggest visiting ssa.gov to get an estimate of your Social Security benefits. Understanding how your benefits fit into your overall income is crucial, especially since they can impact your tax bracket.
Right, and the more you know, the more effectively you can plan. Are there any specific books or podcasts you think people should check out?
Definitely. I'd recommend The Simple Path to Wealth by J.L. Collins. It's an easy read and breaks down investing and retirement planning in a really straightforward way. Also, the Mad Fientist podcast dives deep into financial independence, including taxes.
Those sound like great resources. I love that they're accessible too.
Yes, and remember, it's never too late to improve your retirement plan. Even small steps can make a big difference.
Speaking of small steps, what would be a good habit for listeners to start right away?
One simple habit is to review your investment portfolio quarterly. Just take a look at what's working, what's not, and how your capital gains might be impacted.
That's a manageable way to stay on top of things, for sure.
And running retirement projections regularly can really help you stay informed about how your current investments might grow over time.
I love that idea. It's all about being proactive, right?
Exactly. And don't forget to utilize tax software when you file your taxes. Many of them have built-in tools to help you understand your capital gains and how to minimize them.
That's a solid tip. So if someone's feeling a bit lost, having the right tools can really set them on the right path.
Yes, and it's important to remember that you don't have to do this alone. Working with a financial advisor can also provide tailored advice to fit your unique situation.
That's a really reassuring thought. Just knowing there are options out there makes a big difference.
Absolutely. So those are some practical first steps. Now let's bring this all together. So as we wrap up our discussion on understanding capital gains tax in retirement, let's highlight some key takeaways. First off, it's crucial to know how capital gains tax works, especially when you're thinking about selling assets.
Right. And remember, long-term gains are taxed at a lower rate than short-term gains, so holding on to your investments can really pay off.
Exactly. And don't forget about the importance of tax loss harvesting. It can help offset some of those gains, which is a smart strategy to keep in mind.
And we also talked about the significance of the primary residence exclusion. If you've lived in your home for 2 out of the last 5 years, you can potentially exclude a good chunk of your gains from taxes.
Yes, that's a game changer for many people. Lastly, planning ahead is essential. Knowing your tax bracket and anticipating when to sell can make a big difference in your overall retirement strategy.
Such valuable points, David. It really is all about building and protecting your retirement wealth. When you're informed, you can make decisions that not only benefit you now, but also in the long run.
Absolutely. If you found today's conversation helpful, please take a moment to like this episode, subscribe to our channel, and share your biggest takeaway or any questions you might have in the comments.
And don't forget to share this episode with someone who's planning for retirement or already in it. This information can really empower them on their journey.
Looking ahead, next time we'll dive into downsizing your home for retirement income. It's a topic that can open up so many possibilities.
Can't wait for that discussion. Until then, take care. And remember, you've got the power to shape your retirement.
Yes, indeed. Thanks for joining us.
Bye for now.